If you live and work in Japan and you're planning to stay here, iDeCo is probably the best way to save and invest for retirement. So iDeCo stands for Individual Defined Contribution Account and is basically a kind of private pension in a way. So it's an investment account that you put in money every month, and that reduces your taxable income, so it reduces the amount of income tax you have to pay. In exchange, those funds are locked up until you're 60. So you can't use them before then, and you can invest them in a variety of funds, and those funds will grow over time, and eventually you'll get a tax-advantaged payout as well. So if you're working here and you're planning to retire here, that's probably the best way to put some money away and get it working for you until you reach retirement. You can open an iDeCo account with a whole range of different banks and brokers and financial providers. I think the best option for most people is going to be an online broker. And in Japan, the three big online brokers are Rakuten Securities, SBI Securities, and Monex Securities. And of the three, I use Rakuten the most. So in this video, I'm going to go through the Rakuten iDeCo lineup of funds. There are 32 funds in the lineup, and I will explain briefly what each of them is and why you might consider investing in them, or maybe you might consider avoiding them.
All right, we're going to start here inside the Rakuten website on the iDeCo page. If you're not sure how to get to the iDeCo page, it's really easy. You just go to this menu item over here, Kakute Kyoshitsu Nenkin iDeCo, and that will take you straight here. And one of the really nice things about Rakuten for iDeCo is that unlike other providers, the iDeCo page is actually within the same Rakuten Securities website. So, for example, with Monex and SBI, you'd actually be taken to a separate website for SBI with a separate login. Whereas with Rakuten, it's all within the same system. It's very nice in that way. So this is the top page of iDeCo. I'm just going to go through here, and then we're going to look at what funds are available in the Rakuten iDeCo account. So here we can see the basic information. So this is the total, the current total value of my iDeCo holdings. This is how much I put in. This is the gain so far, the cumulative gain. And I have no idea how they work out this number because it doesn't seem to match any of these, but you know, it's fine. I don't really pay much attention to this percentage. I just compare these two if I'm feeling that way and see how I'm feeling. Now over here, we can see a couple of functions. So this function here is it just gives you this graph of how your holdings have done over time. So as you can see up to here, I was on the Kyosai iDeCo, which is only 12,000 yen a month. And then I left my university job, and it took ages to get the paperwork process to change. And once it changed, I was now paying in much more. So you can see these steps are going up higher, right? And that'll give you this kind of information. Let's go back to the top. Top always takes you back to that first page. All right, and then here we can see recent orders. So my iDeCo account's very, very simple. So you can see here, these are the dates of the orders. I think this is when the money comes in, when you buy the fund, and then when the fund actually hits your account here. And as you can see, I was paying in 67,000 yen a month, and there is a small fee. There's 171 yen a month fee for this account, which is pretty standard. All providers have a small fee for iDeCo. Right, let's go back to the top page. Okay, and then down here, we can see that 100% of my funds are in domestic and international stocks. So there's a mix, so we can change our allocation. So right now, 100% of my monthly payment is going into this one fund here. If I wanted to change that, I could click here and change my future allocations so that I wasn't putting 100% into this. I was putting, say, 50% into this and 50% into something else. And you can do that here. And the other thing you can do is called switching. And switching allows you to move your money, so to sell your current investments and buy different ones with that money. And that's a really nice thing about iDeCo. It allows you to rebalance within the account. So if you decide that one investment is not serving your needs properly, you can sell it and buy a different investment with the same money, and the money stays within the tax shelter of iDeCo. It doesn't have to come out. You don't lose your allowance like you do with the current NISA program. Anyway, that's how this page works, but today we're mainly going to look at the funds available, because when you set up your iDeCo account, you're going to have to choose which funds to put your money into. And fortunately, there's only 32 funds in the Rakuten iDeCo. The iDeCo accounts are limited, so they're not allowed to have lots of funds to make it easier for people to choose. And basically, there's only 32, as you can see here. One of those funds is a cash deposit fund. So this is not invested, this is cash, and as such, the value is guaranteed. So you're not going to lose money, although you will lose value to inflation if you put your money in here. And this might be an option for American citizens because it's not a mutual fund like all the other funds in iDeCo. It's just a cash fund. So for American citizens, I guess you could use iDeCo by putting your money into iDeCo, getting the income tax benefit from that, and just putting your funds into this cash account. And as soon as you hit 60, you take your cash out and invest it in something more productive. But for everyone else, we probably want to invest our money, so it's working for us. Right, let's just look at the top items on this menu, and then we'll go down the side, and then we'll look at each fund. So this is the type of investment, so it's things like stocks or bonds. This is the name of the fund. This is how many assets there are in the fund in oku. So if we kind of roughly say that one oku is $1 million, we can see that some funds are pretty small. This iTrust is probably a newish fund. It's very, very small. Only has about $35 million worth of assets in it. And some funds are much more established. So this Fidelity fund has like $4 billion in it. So generally speaking, the larger the fund, the safer, the more stable it is, all things being equal. That doesn't mean smaller funds are bad. It's just that larger funds tend to be more established and have a longer track record and so on. This is the value of the fund. This doesn't matter because we can just buy in yen increments, so you don't really have to buy units of these funds. And this is the return, so the 6-month return, the 1-year return, the 3-year return. So the 3-year return is the average return per year of that thing. And confusingly, red is good and green is bad. So it's the opposite of what you might expect. So don't get shocked if you see lots of red on your account. It's actually probably a good thing. And then here, this is probably the most important number, which is the annual fee. We want this number to be as low as possible. And we don't want to be paying a lot of fees here because a high management fee is going to take away your profits, and over time the compounding effect means that even what looks like a small fee can make an enormous difference to how much money you actually make through the investment. Okay, so that was the top line. Just you have to remember where this is because it doesn't scroll with it, unfortunately. It'd be nice if it came with us, but basically, so the name, the returns, and then the fee at the end is really important. And here we have categories. So this is domestic stocks. So this is the Japanese stock market. This is domestic bonds. This is domestic REITs. So REITs are real estate investment trusts, and they basically, it's like an index fund for real estate. So the fund buys a bunch of real estate, and then you can buy pieces of the fund, and then you own the real estate. This is international stocks, international bonds, international REITs. Pretty simple. And then this is a mix. So a mix of domestic and international stocks. So these would be like the whole world funds that include Japan. Commodities, this is largely gold and so on. Balanced funds, these are funds that have stocks and bonds and other asset classes together. And then these target year funds are funds that give you a mix of stocks and bonds, and over time they reduce the amount of stocks and they increase the amount of bonds, so that when you hit the target year, it's mostly invested in bonds. This can be useful if you really don't want to think about your investments, but I would argue that these funds are a bit too conservative, and we'll talk about that in a minute when we go through the funds. So let's go through each fund individually. So first of all, we have this index fund of Japanese stocks. It's got a low annual fee. I like that. Looks decent. The Tawara No Load series is a pretty good series. This is the Nikkei 225 though. And the difference here is I'm guessing this is invested in the topics. Let's have a quick look. So this is the info page for each fund. It looks similar. So you've got the fee again, got the price, got the amount of assets, and so on, the performance. You can look at different timescales of performance and so on. And then here we've got the prospectus, and then I guess this is what the fund aims to do and so on. So if we look here, we can see what this is, and we can get some more information. Let's see. So this is the topics, yeah, as I thought. So let's go back there. So basically this first fund is invested in the topics, and that's basically a bigger index of Japanese stocks that includes medium-sized and small companies as well as the big companies. And the difference between that and the Nikkei 225 is that the Nikkei 225 only includes the biggest 225 companies. I would argue that the first one is better because it gives you more diversification. It gives you access to smaller companies that might be growing quicker. So of these two, not only is it a broader index, but it also has a lower fee. So I would say if you want to buy Japanese stock funds, this first one might be a better option. And then we have this I Trust Japanese stocks. It looks by the fee to be an active fund. So these are passive funds. They just buy the index. They don't make any judgment calls. Active funds like these remaining three are choosing stocks because they think or they claim that they can beat the indexes. And generally that's not true, and the higher fees will kill your returns. So I would avoid these latter ones here. Okay, and then down here looking at the bonds, we got similar things. So there's no Tawara No Load, low fee. I would just buy that. These are domestic bonds. And this has a much higher fee, so I wouldn't use that one basically, just on the basis of the fees, to be honest. Domestic REITs, same thing. We've got a passive REIT here and we've got an active REIT here. And again, I would say if you buy the passive REIT over the long term, over a decade or two, you're going to make much more money than paying this fee for the active one. With international stocks, again, we've got a similar kind of thing. So Tawara No Load, this is developed country stocks. So it's basically Europe, developed countries in Asia, apart from Japan, America, Canada, Australia, and so on. And it's got a very low fee, so that's a decent option. Over here, index fund Coco. So these are emerging market stocks. This is like Brazil, China. I think Korea might still be an emerging market stock, but yeah, it's these emerging markets. And the fee is quite a bit higher. This is way too expensive. So again, this is an active fund that's choosing stocks, and you're paying a much bigger fee for the privilege. Although the returns have been good, the fact that they had good returns for a few years doesn't actually mean that they'll have good returns in the future. I mean, if you compare it to the Tawara No Load for developed countries, that's actually made better returns. And the fees that much smaller. So I would avoid this kind of thing. Same here. And this is basically, this is the American, this is basically a Vanguard ETF. I'm guessing it's VTI. So it's the US stock market, and it's wrapped in a fund for Rakuten. It's kind of a collaboration between Rakuten and the Vanguard group in the US. And it's basically a US stock fund with a reasonable fee and so on. Right, down into foreign bonds. So again, we've got the Tawara no load developed country bonds. Very nice. And the same product with a hedge. So what the hedge means is that they try to compensate for exchange rate movements. So to try and cancel out exchange rate movements. And what that means is that you pay a higher fee because it costs money to do the hedge. And also sometimes exchange rate movements go in your favor. So I'm not sure it's necessary to hedge. Some people do believe it's important to hedge, especially bond funds, because you want your bond funds to be stable and not affected by currency movements. But I think it's up for debate, and you'd have to do some reading if you wanted to decide between these two. Emerging market bonds, I believe, are best to avoid because they're quite volatile. So they don't really work the way you want a bond to. And there's also sometimes issues with regulatory kind of legal frameworks. The legal frameworks aren't as strong. The protections aren't as strong. Classic example is Argentina, which defaults on its bonds every so often. So I would probably avoid emerging market bonds unless you really understand them and know why you want to buy them. And then this fund with the high fee is basically choosing high yield bonds from the US. And again, I wouldn't really get involved with that if I were you. If you want high yield or high growth, get a stock fund. Bond funds really should be there to provide stability for you. And then foreign REITs, that's a reasonable fee, I guess, if you want exposure to foreign real estate. And then we've got these mixed funds. So these are funds that have both domestic and foreign equities in them. And there's only two. This is horrible. It's a really high fee. And it's basically choosing... sorry, I'll just go back there. It's basically choosing funds, choosing stocks that they think will grow. But I would skip that entirely and just buy this one, which is the Vanguard VT ETF wrapped in a Rakuten wrapper. And this is what I have. It's basically a whole world stock fund. It includes developed markets and emerging markets and Japan, all in one fund with a low fee. Very, very easy. I think just buying this is a really good option for a lot of people. Commodities. So this is gold. And it's hedged, and you're paying a high fee. Warren Buffett says gold is completely useless because it doesn't produce anything. It doesn't actually provide any value. It just sits there. And I would tend to agree with Mr. Buffett. These balanced funds. The first problem with the balanced funds is that the fees are quite high. Although that last one's nice. We'll have a quick look at that in a minute. But these top four fees are really high, and most of the time the contents are not really what you'd want. It's probably better to make your own portfolio by buying, 2 or 3 different funds from the list, rather than buying one of these funds that's basically probably not going to match what you need. Let's have a quick look at this DC one. The fee's reasonable. The fee's pretty nice. Let's see what's inside it. I'm hoping this is actually on the screen, but we'll see. It'd be funny if you couldn't see this. Okay, so what's in the fund? It's basically got the world stocks and world bonds. Okay, so this is a global stocks and global bonds fund. Let's see if I can find the proportions. Okay, so... okay, that's why it's cheap. Right. So this fund is fine, but it's 85% bonds and 15% stocks, which for most people is totally out of whack because your stocks are going to be growing, your bonds are there for stability. If you've got 85% bonds, it's going to be super stable and not grow very much. So not really the best long-term investment, because you want your long-term investments to grow as much as possible over decades, right? And in the meantime, they'll go up and down, be volatile, but you should get that growth in the long term. And that's also the problem with these target year return funds, because the fund, other than having this really high fee, which, you know, if you bought a stock fund and a bond fund, you'd be paying about 0.2% for each one. And this, you're paying 4 times as much for no reason. Plus, these funds, the target year allocation is again 85-15. So they're going 85% stocks, 15% bonds. So basically, if you bought this 2030 fund, but at 2030, the allocation would be 85-15 bonds, stocks. And as it gets closer, they shift more money into the bonds as you go. So if you bought this 2050 fund, right now you'd have maybe half and half stocks and bonds. But as you got closer to 2050, they'd move more of the money to the bonds. Again, very conservative and probably not what I would recommend for most people. My own allocation for my portfolio is 80% stocks, 20% bonds. I've got 20 or 30 years ahead of me, and I'm happy to see the value of my portfolio go up and down. It doesn't really faze me very much, so I'm going for growth in the long term. And you'll want to think about what your target allocation is going to be between stocks and bonds if you have stocks and bonds in your portfolio, but it's probably not going to be 85-15. And that's the cash fund. So basically, these are the funds available in Rakuten. When you open your account, as part of opening it, you'll have to decide what your initial allocation is going to be. So you can choose any number of funds and allocate basically any percentage of your monthly fee into each fund. So you could have 10 funds and put 10% of your fee into each, or you could have one fund and put 100% of your monthly fee into it. It's very flexible. You can change your mind going forward, so you can change your future order balance, and you can also change your existing investment allocation. So it's really flexible. You can't really make a mistake because you can change your investments later. So if you haven't got an iDeCo account, I would recommend getting one. The tax benefits are huge, and it's a really easy way to save for retirement.